Good afternoon. This is Jim Harvey, president of Opus 111 Group, founder and chief investment officer, and it is the last trading day of 2022. And naturally, it's holiday time. Everybody's had a chance to get together, and it's a time that we naturally reflect on not only the people that are important to us and our loved ones and our families, but also on the year that was. So this being the last trading day of the year, I thought I would take a few minutes to reflect on 2022, talk about what we might expect thematically in 2023, give you some interesting data points to keep in mind about some critical stocks performance, particularly the large cap growth stocks, and just tee things up for next year. I know that here at Opus 111 Group, we're looking forward to our strategic planning retreat the second week of January, in which we're having everybody here, and we're going to spend 3 days talking about these things in more detail. We're going to have a client dinner in February, right the day before Valentine's Day. And we're going to roll out a lot of new service initiatives. Obviously, for our clients, we've just made a transition literally just a little bit more than a year ago, from one firm to a new broker-dealer, Commonwealth Financial Network, based out of Waltham, Mass, outside of Boston. And it's been a year of adjustments. There's no question. And so for our clients, thank you for putting up with this, for staying true to us, making the move with us. We're extremely pleased with the services that we've been able to enjoy at Commonwealth, and we're looking forward to a long tenure with them as we continue to help you achieve your goals and objectives and retire and live the life you envision. So let's talk a little bit more generically about 2022. First, I want to say that some of the data that I'm getting from this is from a good friend of mine, Phil Blancato, who's the president and chief investment officer of Ladenburg Thalmann Asset Management. They manage a couple $2 billion. Phil and I have become good friends, and he recently sent a podcast that raised a bunch of points that I'm going to share with you as well. But this has been a weird year, primarily because, first of all, the market is down. Unlike the situation last year where we had 3 consecutive years of gains going into the end of last year, and so we could not find any tax losses to take to offset those gains, because collectively the market had been up 72% over the previous 3 years combined. That has certainly not been the case this year. And when you look at the data in terms of what the various stock market indices have done, it's reflected. And I know Phil was thinking that the stock market, the S&P, would be down 15 or 5%. It's actually down 20%, close to, at the end of trading. The Dow Jones, however, is only down 9.75, reflecting an obvious thing, which is that the Dow Jones are large cap value stocks. The S&P is a broader base index and has been dominated for the last more than decade of large cap tech stocks like Amazon and Google and Microsoft, et cetera, and Tesla most recently. And, the NASDAQ 100, which is also very heavily dominated by those same 5 companies, was down 34%. The Russell 1000, which is a broad base index of large cap value and mid cap value, large cap and mid cap stocks, both value and growth, was down 21%. The Russell 2000, which is the next 2000 stocks in terms of market cap, was down 22%. The Russell 3000, which is all 3,000, was down 21.4%. So, it's been a tough market in the United States, but we're not alone. Although it's interesting, the FTSE 100, which is, developed Europe, was down 0.71%. And as our clients know, we have always maintained an exposure to developed international, and there's a good reason for it. The point is to have a diversification, which means that you're not trying to bet which sector, which market, which market cap area to focus on. You have an exposure to all of it. necessarily means that you're not going to do as well when any single market goes way up. But the converse is equally true. You will not do as bad when a single market goes down, say like the S&P. Now, if you look at the MSCI EFA, that's down 27%, and the MSCI All Cap World Index, which of course includes the US, was down 21%. The MSCI Emerging Markets was down 21%. The Nikkei, the Japanese stock market index, was down just shy of 11%. But here's the one that's really not one that we expected, and that is that the Barclays Aggregate Bond Index, a proxy for corporate bond holdings in the United States, was down 13%. Now, why do I say that? Because it's extremely unusual to have a situation in which the stock market is down, but the bond market doesn't provide some ballast. Now, you could say that, the bond market only being down 13 when, the average US stock is down 20 to 30%, is a bit of ballast. But in the past, the old rule of thumb was that you would expect the bond market to either be flat or slightly up when that happens. It's not what happened this year, and that's part of what makes this year so disappointing. I mean, it's always disappointing when the stock market goes down, but to not have the bond market provide that ballast that it typically has done in the past is unusual. Now, why is that? Well, here's a perfect example. If you look at the 10-year Treasury, and this data is not through the close, but just almost to the close, the 10-year US Treasury bond is up 138% in yield this year. And very interesting also, two commodities that everybody quotes and is very important didn't also provide much in the way of protection from inflation. Gold was actually down 2.2% when we know inflation is at the highest level it's been in 40 years. And oil is only up 0.66%. However, it peaked. So right now it's about $78 a barrel. It peaked at $123 a barrel. So that was a 60% increase. But from the start of the year to the end of the year, it's only up 0.66%. So, not surprisingly, nobody's happy when the market doesn't do well. The question is why? I mean, why are the markets being disappointing? Well, first of all, the obvious thing is that the Fed has not broken the back of inflation. They've been doing hikes, but we're not getting enough bad news for the Fed to hold back off. And this is one of those instances in which, been in the business 40 years, we say in bull markets, bad news is good news and good news is good news. And in bear markets, bad news is bad news and good news is bad news. And right now with the Fed, the news hasn't been bad enough for them to back off the Fed rate hikes. Now, we had hoped that they might stop in January, February, and maybe have two hikes next year. I think the data, and we're going to go over that in a minute, isn't sufficiently bad for them to not raise rates another 2 to 3 times. And, obviously that puts pressure on the stock and bond market. But it also has another effect, and that is that the rising interest rates raises the cost of financing for corporations, which means that, and this is especially true of the tech companies, that have enjoyed a very low cost of capital. Now suddenly, if they need more capital, they're going to have to go out there and do it in a higher interest rate environment, which obviously is going to put downward pressure on earnings. So the fact is that the bond market hasn't gotten quite there yet. The Dow stocks have had the best quarters that they've had since 2020 in terms of being an actual positive return for the last quarter. Despite the Fed reducing rate hike percentages, those dividend-paying large cap value stocks have done well. Why did rates go up in the first place? Well, first of all, inflation drove prices higher. Secondly, it's the supply-demand break due to supply chain disruptions. And what's happened is that the Fed actions have not been enough, and we're expecting it to slow down next year unless inflation comes down quickly. So I would expect 3 hikes next year, but probably not at 75 basis points a pop. In addition, it's hard to understand inflation when we still have numbers that are still looking pretty good in terms of new unemployment claims. So right now, new unemployment claims over the last month is about 260,000 people. But we think, in order for the Fed to put the brakes on hiking rates, that number needs to be closer to 350 and 400,000. So this is what makes it so weird, because you're like, oh, okay, so we're looking for bad news to get the good news. And the good news would be that the Fed would stop hiking rates, and therefore less pressure on the market, less pressure on creating potentially a recession and whatever. So it didn't get worse enough. And whenever it got better, in terms it did in this case, was better than expectations, then that's a problem. So the labor market is continuing to be strong. And we have a significant gap in people that are available to do the job. What's ironic is that we need to import about 1 million people into the country, and right now we're only emigrating about 125,000 a year. Now that seems a lot, weird and counterintuitive, especially for people that feel like, oh my gosh, immigration's out of control. But we're short about 4 million people who need to come to work, whether they're people that are currently either retired or stopped working because they saved a lot of money, or we need to bring people in from outside, because we have 10 million on 8 to 10 million jobs available, and we're 4 to 6 million short. So structurally, the U.S. economy is in a tough place. The Fed is hiking rates, and the intention is to break the back of inflation. But there are other things that are preventing them from doing this. First of all, the labor market that needs people needs those people regardless of what it costs. That's an inflationary factor. Companies are earning less because of the higher cost of capital, and will going into next year. And realistically, they're going to need to cut wages in order to put downward pressure on those costs. But the current labor situation makes that virtually impossible, because there's such a demand for labor and a lack of supply. Now, the other thing is the estimated growth is too high for the Fed to slow down. So the third quarter revised numbers for GDP growth was up 3.2%. That's higher than people expected. It was recently revised up. Inflation won't slow down at that rate. Now, I think and I agree with Phil on this, I think they're missing the point, because the supply chain is largely healed and goods inflation is starting to come down. But evidently that's not bad enough news for the Fed to take their foot off the brake. Now, another figure that is commonly quoted, and it's one that you've probably heard people say on broadcasts and the like, is called the PCE, Personal Consumption Expenditure. And the Fed quotes that a lot. That number came in at a 0.4% gain, but it beat expectations for the month. So if you take energy and food out of it, it was still up 0.2%. So if the cost of buying things is still going up, then it's higher than the Fed would like it to be. So basically, the bottom line is, with respect to inflation and the Fed, it's not decreasing fast enough. And therefore, that's why I think we're going to probably see more Fed increases next year, although probably not at the same pace as they have been. So, even durable goods orders sank last month nearly twice as much as expected, and demand for stuff is slowing down. Month over month retail spending is down. November spending is weak, but it's still indicates a stronger economy, despite the fact that while spending is weakening, it's still strong when you look at it not month over month, but year over year. So like I said before, we're in a weird place where good news is bad news. Not enough people are applying for unemployment, or whether the cost of what you're buying is going down, it's still too high in the opinion of the Fed. So the Fed is not done, and we think it's pretty clear that they'll do at least 2, maybe 3 increases next year. Now, there's some other things that would contribute to the persistency of inflation being up. I did a piece not too long ago talking about the impact of housing inflation and the fact that it takes a while for housing inflation to be reflected in the numbers. That's certainly one thing. It represents 31% of the CPI. But if you look back at 2020 and 2021, I think collectively they said in 2020, the cost of housing in the US was up 2%, and 2021 was up, 2.5%. But realistically, we know from 2020 to mid part of 2022, the average price of a home in the US was up 28%. So those numbers have not filtered through the system. In addition, government just passed a $1.7 trillion government spending bill. And, some of it's for Ukraine and some of it's for, infrastructure, but $700 billion of it is discretionary. And that portion could increase inflationary pressure. So, what happens? Well, you could stick your head in the sand and go, woe is me, or let's look at some other ways to look at some of this. So for example, let's look at what happens after the Fed stops increasing interest rates. After each time the Fed has stopped hiking, the market is up an average of 215% over the next 12 to 24 months. That's huge. Let's also not forget that the market is higher 12 months from the beginning of Fed hiking process, literally every time over the last 11 cycles. Now, 2023 represents the third year of an election cycle, which tends to be the best year in the election cycle. So despite the fact that, if you're a Republican, you might be licking your wounds because you didn't have the red wave that you were expecting, the fact is that in general, the third year of any president's tenure, whether Republican or Democrat, tends to be really good. And so we feel that there's a pretty good chance that we will recover everything that we've lost this year. And obviously, when people look at their accounts and when we're doing our reviews, we're creating some significant alpha by not losing as much as the market when it goes down. And of course, we had two compounding factors this year. Not only is the stock market down, but the bond market is down too. Now, one of the things that I mentioned earlier is that in 2022 or 2021, we could not find any tax losses to take. And so as a consequence, our clients got a pretty significant capital gain bill. We just recently completed all our tax loss selling, and I don't think there's a single client that has a positive, in other words, we have been doing tax efficient investing by making sure that you're taking losses. And if you don't use them all up this year, the good news is at least, and I always say this, at least under current tax law, you get to carry them forward. So why do we do that? Well, because we expect in the future we'll have gains. And we truly think that as we look at 2023, is inflation going to be higher than where we think it'll end up settling down to? For sure. But I think that it's highly unlikely, for example, that the bond market will continue to get bashed next year as it has this year. So one of the things that we're actively looking at right now, as interest rates have gone up quite a bit, and I remember looking at corporate rates at 1%, actually municipal bond rates were 1% a year ago, they're 4% now, and I think Barclays aggregate bonds were 2%, and now it's 5%. With those higher interest rates, if we expect at some point the Fed to stop hiking rates, which will allow rates to come down. If you buy bonds now and maybe even go out into slightly longer maturities, you're going to get a higher coupon rate, presumably, and potential price appreciation in the bonds that you might buy right now should rates drop over the next 12, 24, 36 months. So that's something that we're looking at. In addition, dividend-paying stocks still are in vogue, as indicated by the relative outperformance of the Dow being only down less than 10% when the S&P is down 20%. And they also are paying some nice dividends. So I think that's interesting. I know that the average large cap value stock is down about, 7%, and the average growth stock is down 25%. So this process of losing less when the markets are down is critical to long-term success. And this is what we do. This is our job, is to help you lose less And the advantage of that is twofold. First of all, it's a lot easier on your sleep and digestion, let's face it. The second thing is, if you've lost less, you don't need to make up ground. We don't like to give real estate back. And so that's what we're talking about. And so, that's a pretty interesting thing. Now, the other thing to bear in mind, and then I'm going to show you some data, which I think is very interesting about the S&P 500 top 5 and the NASDAQ top 5 and top 10 stocks in terms of their performance and their percentage of the index and where they are in ranks, at least on the S&P, et cetera. But unfortunately, as we look forward to economic news right now, and remember, I've always said this, the stock market is not the economy and the economy is not the stock market, but they know each other, right? So like, they're not unrelated, but it's not a lockstep relationship. It's not a direct one-to-one correlation. And so holiday shopping, generally the fourth quarter is what we call the Santa Claus rally. That's been a little bit less. And the PCE, the personal consumption expenditures, are still strong, but the month-to-month data is not declining fast enough for the Fed. So as we look forward to this next year, there's some things to bear in mind. First of all, there's always opportunity. So you want to own the dividend, continue to have those large cap value stocks. If you don't have them, this is a good time to look at them. We're looking at adding longer bonds back to the portfolio for most of our clients. We have short-term bonds, and they've actually done the job this year. But now I think when the Fed slows down rate hikes, inflation is broken, better days are to come. Let's talk about the recession. That's in the back of everybody's mind. So next year, are we going to look at a recession? Yeah, I think so. Probably the first 6 months. But we think it's going to be mild based on the unique environment in which we find ourselves. A strong consumer. We have a strong savings rate among consumers. The economy is weak, but is not, terrible. And the Fed is going to continue to try to raise interest rates to offset inflation. What's different is no matter where you put your equity money, the U.S. is not out of the woods. Japan is in a terrible situation with their interest rates and the economy and their high debt levels. Europe is still just beginning their way on hiking yields, and so they're behind us. So there's just no place to hide, from downside in the market. And so that's part of the reason, folks, why we don't just say, oh, we're all domestic or we're all international. We're going to take all our money and put it in emerging markets because that's where to have it. We don't do that. And so it makes for an easier ride. It also makes for a less volatile portfolio in general. But demographics matter. And that's not a perfect science, but there is a strong correlation between economic growth and population growth. As the size of countries' population increases, so does their productivity because there's more economic activity. So it's interesting. China's population is shrinking. Until recently, the US population was shrinking. Right now, we have about 333 million people. But this last year, we had 1.3 million more people than the year before. We had 240,000 more births than deaths, even though it's been slowing since pre-COVID. But again, immigration is important. We need a positive immigration policy to get those workers in from overseas to take some of the jobs that we have. Another interesting point to keep in mind is state increases due to tax policy. So 18 states lost people, the most significant being New York, but also Illinois, Massachusetts. Where are they heading? Well, they're heading where they pay less taxes. Idaho is up 2%, South Carolina up 1.7%, Florida 1.9%. Florida alone has 440,000 new people over the last year. That's 1,200 new people a day moving to Florida. Texas up 1.6%. So those states' economic productivity will follow. So while we think that there's no question that 2022 has been a difficult year, it's been disappointing results on several fronts, not only the stock market, but in particular the bond market, that the Santa Claus rally is not really panning out the way we'd hoped, and that economic data is too strong for the Fed to stop hiking rates. but we think there's always reason to be optimistic. So what to expect in 2023? Well, I think we're going to see us start to grind higher. We'll have a soft recession, as I mentioned before, but I think consumer savings, consumer strength are strong. Corporate earnings have hung in there, but they're going to take a bit of a hit in the first 2 quarters. It may take a little bit longer. The first 6 months are probably going to be very volatile in the market, which means that things like commodities are going to do well because the more volatile, the better. That will also create more opportunity for capturing increases in interest rates, and in particular for people that have annuities or are looking at putting money to work in annuities. It means that the cap rates are going to be higher. The guaranteed rates that they pay will probably be higher. So until we get a sense of the extent of the recession, we won't really know, but we do expect the recession to be shallow. So before I wrap up, I did want to talk about something that we've talked about quite a lot over the last couple of years. I do a lecture at Stanford twice a year, and most recently I looked at the concentration risk, if you will, in the S&P 500, and the top 5 stocks. Apple, Microsoft, Google in its 2 iterations, Amazon and Tesla, represented, I think, when I did the lecture in October, it was like 23%. Now it's 21.5%. But what I also did on that chart for the first time is I looked at what was the year-to-date performance through October, and in every single case, it got worse. And so I'm just going to quote these numbers and give you a sense of how profound a risk you take when you just put money in an index, when you've got 5 stocks that comprise 21% of the entire index of 500 stocks. And so I looked at the top 5 and top 10, and let me just run these down. So the number 1 market cap stock in the S&P as of December 29th was Apple. Year to date, it was down 29%, and it ranks at 368 out of the 500 stocks. And the S&P percentage that it represents is 7. But market cap wise, it ended the year at about $2 trillion. I mean, it's huge. But it lost $811 billion. So it's 28% off of its market peak, which occurred in April. Microsoft down 28% for the year, ranked 375th among the 500 stocks, represents 5.6% of the index. It lost 26% of its market cap, which was in February. Google represents about almost 6%. But it's down 39.72%. The L shares and the GOOGL was down 39.72. The GOOG was down 39.49, and it's lost 42% of its market cap off its peak, which happened in February. Amazon down 51%, ranked 477 out of the 500 stocks, lost 50% of its market cap. 50. And then everybody's favorite, bad boy, Elon Musk with Tesla, it's off 69.57%, and it is ranked 500th out of the stocks. And it represents about 1.96% of the index, but it lost 66% of its market cap off its peak, $737 billion. So at the peak, it was worth 1.1 trillion. And now it's worth 382 billion, and it's lost $737 billion in market cap. So those are the top 5 if you combine Google and Google. But then what about the next 5? And the next 5 are pretty interesting. So if you look at all of those 5 together, they represent 21% of the index, but their performance for the year was down 42.99%. If you add the next 5, then that number jumps from down 42.99% to down 17. So the next 5 stocks, which are Berkshire Hathaway, United Healthcare, Johnson & Johnson, ExxonMobil, and JP Morgan, which, by the way, are all large cap value stocks, they brought the performance of the top five down to 17%. And collectively, those 10 companies represent 28.4% of the index. So why do I quote all this? Well, look, people tend to fall in love with stocks. We call it the endowment effect. And the reality about that is people tend to fall in love with what's done well. They forget that you really need to kind of do a good job of getting out of these markets when you get a chance and taking those profits, which of course our clients know. I've been telling people for the last several years. And so not surprisingly, ExxonMobil, to give you an idea, was ranked 6th of those out of the 500. Next was United Healthcare at 116th. Then was Johnson & Johnson at 125th. Then was Berkshire Hathaway at 128th. And then JP Morgan at 268. So the bottom line here is, just buying the index is I guess, okay. I just think you get a lot more risk associated with it, particularly when it's a market cap index. You could argue if you have an equal weighted index in the S&P, you do better, and that's true. But it really has to do with what decisions you're going to make during that period of time. So, Tesla being down, I don't know whether it's a buy. I think, that's debatable. But Amazon, maybe, it's lost 50% of its market value. So as you look at things, as you're considering this year, as you're looking at your own situation, just keep in mind that, our job is to help you navigate, these times. Things are constantly changing. This is something I've never seen in 40 years, where you see both the stock and the bond market down significantly. So we didn't have that ballast that we typically would expect from bonds. But the good news for our clients is we didn't have that much money in bonds, and where we had that money was fairly short. So this year we may look at, putting more money in bonds. Why? Because we think that we can capture some good rates, and then if rates go down because inflation is broken and interest rates start heading down, and we're seeing that, for example, in certain parts of the market, then we'll do well with that. But our job is to make sure you've got a globally diversified portfolio that really is set to weather the inevitable storms that happen each and every year, as we've pointed out countless times. And most importantly, presumably, and it's certainly historically that's held up, that we have lost less when the market's down. Now, it also means the corollary. We're not going to make as much as a particular segment of the market, the stock market, does as it goes up. But again, we don't need to, and that's important. So as I wrap up, I just want to say it's been such an honor and pleasure to work with you all this year. The good news is, as I said, we've maintained an exposure to large cap dividend paying stocks. Your total portfolio returns have been good. The bond situation has been good. And you certainly have done better than Barclays bond index. But thank you for choosing to work with us and taking some time out of your day to listen to what we have to say. Of course, if there's ever anything you feel that we can do to improve what we do for you, please let us know. And to quote a fond memory of my kids growing up, to quote Buzz Lightyear, onward to 2023 and beyond. So thank you very much. I wish you guys a wonderful New Year celebration, and I look forward to chatting with you next year and bringing you up to speed on some very exciting service improvements and operational changes here at Opus 111 Group. Have a great day and a better year in 2023.